Lokapriya joins us. Good morning, Chakri. India was supposed to be the best performing place where people wanted to invest money, right? But if I look at the performance this year, Japan is up 12%, Nasdaq is up 8%, and all the gains for large cap stocks, even Nifty, are gone. Why is that? What has turned, and why the markets are suddenly looking very shaky?
Good morning, Nikunj. Thanks for having me. I think it started off with the regulator concerns, and that kind of fear kind of percolated down, and the market has lost. Investors have lost about 6 lakh crores in the last week or so, a couple of weeks. So I think that fear is kind of going to linger on for some more time, and therefore put a lid on one of the things that a market needs is confidence, and which is it's lacking right now. But because the earnings are on an uptick, I think the market will be fine.
So, are you a buyer in this market?
Yes, indeed. We've been buying. In fact, like your earlier guest was saying, power for financiers, because they are like an instant gratification story. You'll see the benefit immediately as soon as they lend out to various infrastructure plus power sectors. And so power finance, RECs, we've been buying. We've also been buying into auto ancillaries like, Timken, Schaeffler. They'll all benefit from the EV story, Tesla coming in, and plus underlying earnings momentum.
I'll discuss perhaps the most discussed sector of 2023, which is the entire PSU space. And within that, Naresh, PFC and REC, they've been the poster boys. But in a bull market, when the tide reverses, everything will shake. PFC is down this year by 5%, and REC also has reversed very, very sharply. Let's look at REC this year first, please. I think PFC is down much more. No, I think it's down, right, Kunal? I think something wrong with the graphic.
PFC is down 5%, REC is up 3.5, 3.7%.
From the days, actually this is YTD,
This is YTD.
From the 52-week high, I think the correction is quite brutal.
Yeah. From the 52-week high, PFC I think has fallen 20%.
Is that good enough?
Yeah, it's good enough, reasonable enough. Because when you look at this in comparison with the other PSU names, these stocks have fallen by a margin of 35 to 40%. So I think in that aspect, a correction of 20-25% into formidable names like REC, PFC should be considered as a very good entry point for these stocks.
Okay. Why are FMCG stocks coming under pressure? Chakri, I mean, is there a reason why FMCG stocks, which is supposed to be in the defensive space, that is under pressure?
If you look at FMCG stocks, they're only within that whole basket, for example, Dabur, what has done well is only their premium end of their products. And whereas the mass segment continues to kind of underperform in terms of sales. And, there's no pricing power that any of these companies are having right now. And that they're just thankful that some amount of raw material costs has kind of helped in their margins. So against this whole backdrop of rural being weak, no real big uptick in the range of products, and the consumption is generally slow. We've seen that across consumer segments, and valuations are high. So a combination of high valuations plus no new product innovation, I think will keep this sector still where it is.
Nothing very, very exciting. I go back to this. Let's look at Reliance versus Nifty. I mean, for me, this is just such a diverse kind of a move, and we were talking about it in the morning. Reliance now is up 10% for the year. Nifty has not participated at all. Rarely that happens, Naresh. Rarely.
So the rotation has been very unusual across the board. So if you look at it for the last week, even IT was looking like it was going to make a comeback, and momentum was coming back, and we've seen Infosys and TCS correct. Same way Reliance between 2021 when it topped out for the next 1.5 years, it was an underperformer. And now it has started taking outperformance. And if you add the Geo Finance to it, it has done really well. So overall, the view is we are getting into a period of consolidation because there is no leadership, and that's the problem. So Reliance has been doing well, but then you have HDFC Bank, which has gone nowhere for 4 years. You have Kotak Mahindra Bank, which has gone nowhere for 4 years. Say from pre-COVID prices also, a Kotak Bank and Mahindra Bank have not even made 20% returns, whereas the Nifty has gone from 12,000 to 21,000 plus. So overall, what we are seeing is a lot of heavyweights have gone through this sideways consolidation, and maybe going forward that could be turning around. So Reliance still looks positive till the time it holds about 2700, 2750. But what we need is more support from the heavyweights like HDFC Bank or a Kotak Bank or something in the IT side for the trends to continue.
Chakri, wanted to get in your take on, the ER&D services. Some of the top bets that brokerages are talking about include the likes of a KPIT, Tata Elxsi, Cyient, etc. How would you be looking at your preferences within the space?
That segment, I think, continues to do well. The order flow is still not, the conversion of order flow into revenues still continues to be very strong. And that's the big difference between them and the IT services, where the order flow is there, but it's not able to convert it into revenue. And given that, and given that manufacturing is on an upswing, they will continue to benefit from the whole process, and their margins will continue to expand. And therefore, they will kind of have that slightly bit premium valuation given their focus.
Okay, fair enough. Meantime, OMCs, they've been in the spotlight of late with the fuel price hike. What's the outlook on the entire OMC basket, Chakri?
OMCs is now the story has shifted to, the post-election, the prices can be cut. The question is, prices may not be cut if oil prices move higher. So that's the biggest unknown. And given this level of uncertainty, which always exists in this sector, I would stay away. The valuations have always been cheap, still continue to be cheap. But given the uncertainty, I would stay away. Because, the crude discount that they've been enjoying from the Russian crude last year might not continue into next year. GRMs at high can't be at that cyclical high levels, will have to come down. And plus the uncertainty, combination of these three will stay away on the sidelines.
In this correction, and I'm again being repetitive with this one, which is that we have not seen a very sharp kind of a sell-off in consumer tech stocks. Maybe Nasdaq has not fallen. Maybe that's the way tech is moving globally. Maybe it's because of the Magnificent Eight and what they're doing in terms of where the value is getting created. But consumer tech and new tech stocks have not fallen. Zomato not far away from its all-time high. You don't have any sizable correction in Policy Bazaar. Delivery is not corrected. Paytm has got its own issues. So I would keep Paytm as more like a special situation stock. But that's the way how things are stacked up now. Chakri, why? I mean, this is like a high growth space where valuations are stretched. If markets are correcting because of valuations, this should be the first one to correct.
If you look at, for instance, Zomato, now Zomato is now talking about Blinkit being the next value creator in that space. And so I think that's the nature of the game in the consumer tech and the new tech space, which is these companies, unlike if you rewind back in the past, there was the whole talk was about product focus. But now, no, you have an Ola getting into EV cars, completely unrelated. You would have said a few years ago, but now they're doing it. So as companies in new tech can get into completely different spaces, which are still tech related, but very different, the valuations are being given to them. I think that, so then the keyword comes down to just one word, which is if each of these companies continue to innovate, whether it's new segments or new segments, the valuation you'll keep giving it to them in some form.
Chakri, today we'll be putting the spotlight on the entire power sector. We've got a very special segment that's lined up. It's the guest editor segment, where we'll have none other than the MD and CEO of Tata Power becoming our guest editor. Given that we have seen energy transition really gaining pace, there's been a soar or a very big spike rather in energy demand and electricity demand. Any pertinent questions that you think we should add to our roster of questions to quiz our experts on today?
Yeah, you have an able bunch of you guys out there. But the question is, given that, India's transition to is 2070 by the time it goes all green. And until then, companies like NTPC and the big boys like Tata Power, they have a whole slew out there of acquiring some of the companies which are in NCLT, which are financially stretched, power companies, that is. And once that is revived, all these various, or rather acquired, that adds to the growth rates of companies like NTPC, Tata Power, and all the other companies which are financially strong. So that areas of growth, I think, will continue to drive valuation and worth getting to know their thoughts on.
Okay. So you've also got the auto space that's in the spotlight, and I wanted to get in your take as well, Chakri, on an Eicher Motors. Given that analysts are saying that the risk reward is looking rather compelling for the company, how are you looking at an Eicher Motors in light of the competition that's stacked up?
Eicher Motors, you can actually compare it to an Asian Paints. Asian Paints was the sole person out there, premium paints, no competition, and suddenly you had new entrants and lots of competition's margins coming down. Same story, Eicher Motors, now with Triumph coming in, Harley Davidson coming in, duty structures coming down for those imported bikes. All this works in favor of, which means the consumer has more choice, which means lower margins for Eicher. So, and therefore the multiples will come down. The valuation that one gave it 2 years ago, I think that multiple we would not give it now, and therefore will remain on the sidelines.
It's interesting. We're looking at a pickup in overall digitization, AI, etc. Do you think that a lot of these traditional IT companies are now harnessing the power of the new age technology in a lucrative manner, or that there's still a lot of catch up? And in light of that, how are you looking at some of the listed players, even new age tech?
New age tech, is a kind of evolving thing because, it kind of impacts just about every single sector out there. We had a presentation by one of those tea estate companies, which was looking at automating some of the workforce, replacing them with an AI-enabled robots. Both a good thing and bad thing. It creates unemployment. It improves margins for the company. And, 30% of all kinds of jobs in IT companies are going, the various studies have said will replace humans in IT companies, McKinsey study. So if that is true, then in the next 3, 4, 5 years, for next 5 years or so, let's say, IT company margins, Indian IT company margins can dramatically change depending on how they're able to seize upon managing this mix between AI and employees and retraining. So I think it's something which is going to impact just about everybody. The question is, who embraces it more than the other?
Okay, what held out yesterday? Geo Financials. In a shaky
In the world last year, and the third most polluted city in India in terms of.
If you like this video, then like, share and subscribe to ET Now.